All right, good evening, everybody. We already had a little chat with a few people that are here. Good evening to today's webinar. We're going to be discussing fundamental analysis, and more specifically, we're going to look at fundamental drivers, and we're going to be looking at the news. So retail-wise, fundamental trading, how do you do fundamental analysis? Now, before we get to the actual show, we have to go through the risk disclaimer, so we're just going to go through that real fast. I'm not going to read it out. Take your time, give it a minute. That's long enough. All right, so what are we going to discuss? Well, firstly, I'll introduce myself a little bit, just so you get a little bit of an idea who I am, what I do. Secondly, we're going to look at what the fundamental drivers really are, what are fundamentals when we talk about it in retail trading. Then we're going to look at what the fundamental drivers of the majors are. So I'm going to go through the majors with you. Plus, I'm going to touch on commodities and stocks. I'm also going to look at preparing how to trade before an announcement, right? With this in retail trading, what we deal way more with, we don't much trade with, the real drivers, the underlying drivers, but it's good to understand them. Then we're going to trade fundamentals. So we're going to look at short-term trading, how you would approach that. We're going to look at how you do this more in long-term trading, again, from a retail perspective. And at the end, obviously, we're going to have a Q&A session, and then you guys are free to fire away. Right, so about me, who am I? So like I said, my name is Mike Rottink. I've been a trader in the Forex industry for about 15 years. Obviously, everybody has the same start as me probably. You screw up one account and two accounts, and then you start thinking maybe I should be doing something different. That made a click with me. I started digging a little bit more into why I was trading the way I was and why that wasn't working. So I made the connection in my head at some point and started trading completely different. That resulted into me ending up with, a success story in my trading, allowing me to rotate, out of the retail trading section and put my money into different things, which is more what I do now. What I transitioned into is I am currently looking into becoming a wealth advisor. So obviously investing is a big part of that, where to put your offshore investments, tax planning, stuff like that. But, you need some license for that. So at the moment, I'm just mediating between parties. And obviously I do these webinars and I try to do my coaching, teaching people how to trade Forex, really tailor-made based on what their level is, and a little bit a different approach to the cookie cutter coaches that come from the bigger parties. More of I'm on the same level as you. I'm just a guy that happened to have had success with trading. I never traded assets under management. I never will, so I'll never refer to myself as a professional trader. But yeah, that's what I do. So what are fundamental drivers and fundamentals in retail? So fundamental drivers, there is two terms to this. Now, the first one is more about a sentiment, and that is more in the Forex market. When people say in the Forex industry, like, okay, what are my drivers? They mean the trading sentiment drivers, right? So there is some fundamental background on that one, like interest rates, which are a very good incentive why to trade or where you expect things to trade. But the other ones are more psychological aspects like fear and trading sentiment and all that kind of stuff. That's not what we're talking about with fundamental drivers. The fundamental driver of any currency or commodity or anything else is the underlying um, fundamental building blocks of what gives it its value, right? So if you would look at something like a dollar, right, that currency has several different aspects, and we're going to get to that in a minute. It has several different aspects to it that give it the value that it has, or the perceived value, right? There's no hard number, and that is why your market moves. So the sentiment for the market's pricing is based on the drivers. And there, if you look at a month chart in your trades, you will see that the market doesn't fluctuate really big amounts. It's like a steady growth or a slow moving, and it depends a little bit. Some years it's a little bit down, but in general, there's a little bit of a curve. And the reason that these curves are fairly stable and why bigger parties can trade on this really easy is because fundamental drivers don't technically change all that much. The underlying aspects of them change slightly, but it would require a fundamental shift in any of the drivers for a currency or commodity or stock to actually completely head a different direction, strength-wise on the scale globally, right? So specifically the drivers, we're going to get back into that a little bit later. When we talk about fundamentals in retail, it's more than news announcements. So this is more short-term kind of base. We understand drivers like, policy making. We understand underlying, let's say, assets like, raw material. If it was Germany in the old Deutsche Mark, the Dutch was more on export based, right? So it's sales figures, GDP, stuff like that. But when it comes to the news announcements, it's much more short term. Now, obviously, the biggest known one and the most influential one in the past was the NFP, right? The non-farm payroll, everybody was trading that back in the day, where the NFP was a determining factor to whatever the NFP said was basically what the dollar would do for about a week. Nowadays, it has become significantly less important in the overall scheme, as America has lost a lot of strength globally, but or actually the rest has become more in line with the US, I think it would be a better statement. However, the NFP is still a valid measurement point, but you'd see in the market, if anybody of you have traded fundamentals, you see that the fluctuation is much less than it used to be, right? Like I said, it used to determine the trend for the US dollar across the board for a week. Nowadays, it's like 2 hours of movement, and then it's kind of like back to wherever it was and just continues whatever it was doing, unless there is a ridiculously big fluctuation and out of the range that it was supposed to be in. All right, if that makes sense. Now, when we look at the economic calendar for the retail trade, there are certain things, and there's like these little stars or skulls or exclamation marks or color code or flags or something like that. This is called an impact level. When you look at the economic calendar, usually let's say you have 3 stars, it's expecting to be volatile on the short term. We're not talking about long-term volatility of directional change. We're talking about the short term. So you look at hour, 4-hour charts. It could flip the day occasionally. In case of an interest rate decision, it could flip for a prolonged period. It could be a trend setter, but that's one of the drivers, right? The underlying, monetary policy from the bank is very influential. But everything else, there is like a star rating, or like I said, so if it's 3, it's expected to cause volatility if the result is very different from the expectation. Meaning that if it's the same as the expectation, everything is factored in, nobody cares. Like it's barely gonna move. Occasionally it'll fluctuate a little bit, that's about it. But if you would have, let's say, the NFP, and they expect 200K and it shows up as minus 50,000, yeah, that's such a huge difference where you're not even bad, you're just negative. Then you will get something. Like a few 2 months ago or 3 months ago, we had an NFP where we were expecting it to be extremely low, like 30K, I think it was, and it turned out to be negative. That didn't do anything. Now, why did that not do anything? Because we were already expecting that instead of the standard 170 to 200K, it was going to be like around 20 or 30. At least it was going to be terrible. Even less than that didn't matter because terrible is terrible already. And that is already factored into the market. The pricing has already been done by the bigger parties that make the market move. I have talked about this in different webinars. As you guys know, we don't make the market move, right? We're a drop of water in a big ass ocean. We don't matter. We're just the many funding the few. But it doesn't mean that we can't be smart about it. We need to understand how markets are going to move, what are they going to do, And what are other people doing? And this is how we trade. So the volatility is a very good indicator of that short-term kind of bursty behavior of traders going in and out, especially people that trade on minutes. There's a lot of orders coming in, they trade during that news announcement, and then they all go out. So you get this burst of volume into the market and then leave, but it's usually in one direction, majority of in one direction, right? So things with one star doesn't necessarily mean they're not important. It's not going to create any volatility on the short term, right? Because if you look at monetary policy statements, they usually have one star in economic calendars or one exclamation mark or whatever it is, right? Low volatility impact. But on a fundamental level, the policy making of central banks is huge because it determines how they are seeing how the market is developing and the strength of the underlying asset or instrument or security, whatever you want to call it, right? But if let's say the Fed in the US says like, look, we're very, very hawkish and everything's going to be well, we're basically throwing in the towel. Okay, then you already know that the policy making is going to revolve around. For the big parties, that's all they need to know, because they're going to factor it in. The banks are not going to change their mind that often, right? Because they're usually they use the same approach to market fundamental analysis as the bigger parties do that have these big teams. We don't have access to that, so we need to focus on the smaller stuff. In a big run, we expect, let's say, the euro to climb versus dollar over the year for 6%. It's going to go up 12, down back to 3, and then it's going to wiggle woggle between. But that's what we trade. We trade the movement in between. We don't trade, Q1, 2, and 3. We trade Monday to Friday, if that makes sense. Now, understanding the data is a different thing. And this comes a little bit with, there's no shortcut here. There's a few sites that have the economic calendar where you can click on the actual specific thing. For instance, the NFP. I'm using the NFP because everybody knows what that is. So you do the non-farm payroll and you can see the history of what it showed. And understanding the data is not understanding what it means. It's great if you understand what the NFP exactly is, or what the PMIs exactly are, or when the what's the Japanese report that's once a year. Like, if you understand what really that is, okay, that's great. You don't have to understand it. You need to understand the data and how it affects the market. The way you do that is by back testing it. So every month you have the same announcements at the same time. So learn the key ones, like interest rate decisions, learn the key one like NFP, for instance, if you want to trade short term. And like I said, the impact is less than it used to be, but take one that you think you want to trade on. And then what you do is you take that data, you take the historical data, and every time it announces, you look at what was the expectation, what was the outcome, and how did the market move? And just backtrack it for the last 2-3 years. You don't need to go back 20 years because the market from 10 years ago has nothing to do with market today in any way, shape, or form, apart from sentiment. Right? Even now, you could argue 2020 has significantly changed the underlying tone of the market in general. When we look at retail, when we look at how we live and work, how we deal with everything else. So even going back as far as 2018 might be redundant. Like 2008 crisis, yeah, anything before 2008 has nothing to do with anything after 2008. The markets have shifted. That doesn't mean the fundamental drivers changed. Their levels changed. The fundamentals changed. The market reaction changed, but the core foundation hasn't. It's still calculated in the same way, but obviously the market now looks at other factors as well. There's a variable there of what is relevant to the market now. What are we dealing with? What are we looking at? And you compare that, right? So if you go back 10 years, you find yourself in a market that is so historically out of date compared to current levels that the movements may be the same, but the levels have nothing to do with each other. Unless you get all-time lows or all-time highs or something like that. But again, that's a little bit, what is the current market allowing it to get to a certain point? Let's say the euro dollar goes back to 180, right? Then the reasons why it's there now is not the same as the reasons why it was there in pre-2008. Right? The sentiment is completely different. So this helps you understand the data. And this is really something you will literally just have to sit down for and backtrack it and one by one go through them, et cetera, et cetera. So what I want to discuss next is the drivers, actually the underlying, feel of the majors. I'm going to touch on commodities and stocks as well because they're slightly different, or slightly, they're actually quite different. But obviously the first big one is the one that everybody knows, right? It's a dollar. So when we look at Forex, the US dollar is basically one of the biggest currencies in the world. It actually is the biggest, right? When we look at influence, because basically the overall reserves globally is a little bit over 56%, 57%, something like that nowadays, is in dollars. Now, one of the main aspects of what makes this dollar strength is where we're going to start getting a little bit more interactive. For those that have done webinars with me before, you know exactly what that means. It means that I'm going to start getting you guys involved. So, having that said, the Q&A is always open, that little thingy. I would like to know what 4 things you guys think are the actual drivers of a US dollar. Name one. US economy, yeah, okay. But what is the US economy, right? That's kind of the thing. Okay, we got 2. So yeah, gold, oil, well, gold, metals. Inflation, CPI, economic indicators. Yeah, but what are the drivers? So we're not talking about the fundamental aspects. We're talking about drivers. GDP is a very good point. Politics, yeah, politics is part of it. Yeah. Politics, not so much the determining factor in the driver as in the fundamental, but Fed policy for 100%, right? Nailed it right there. So you basically already named them all, right? You have the oil and metal markets. So that's supply, demand, based fluctuations. That's one of the key drivers to what determines why the dollar is strong. All right, so if you think about it, big part of the metal oil trade are nominated in US dollar, right? We determine gold price by dollar. We determine oil price by dollar. Right, so that should just be like, oh yeah, obviously. Right, so their value and their strength determines the US dollar. But now, this is a little bit less like it used to be. They used to say the US dollar was a safe haven. It's a little bit less now, as we can see that more people flying to the safe haven is more gold than it was the dollar. It still has that it's a stable currency, it's not going anywhere kind of vibe. But, we've had a little bit of questionable leadership in the US for the last few years, which has deteriorated a lot of relationship globally, especially from a financial point of view, and a little bit the trust. Yes, during Trump, for instance, the stock markets went to an all-time high, but overpriced markets doesn't necessarily mean healthy economy. Obviously, the Fed policy rate, yeah, that's that one. Who was that? Who said that policies? Yeah, Eugene and Tibet. Yeah, nailed it. Right. So the federal policy rate is what basically is probably the biggest, because they are literally the voice of this is how we value the US dollar on a global scale. And we are going to build our policy around this based on internal and external economy, based on growth, based on inflation, the whole 9 yards, where we're going to go with bond yields and treasuries and you name it, right? So all those factors have a huge impact on the currency. So the three biggest root causes that make their policy making is the unemployment rate, the inflation, and the GDP figures. That's like the top three, right? And then you get all the other ones that are factored in. Yeah, and the last one is, yes, obviously, international trade. Yeah, again, yeah, what was it? Blue alphabet. Yeah, you nailed it. So yeah, obviously, the US being the US, it's a consumer market. If they stop trading internationally, there's something seriously wrong. So that would directly influence of how strong we view the dollar. Right? So international trade is a very, very good point that you brought out. Cryptos is a good point, but cryptos is not a driver. Cryptos is a completely different animal on its own. It's not a driver connected to a currency. I can get back to that in the Q&A. But that, in essence, is the drivers of the dollar, right? So you have the oil and metal markets. You have the dollar as a safe haven, like kind of investment-wise kind of market. Then there's the Federal Reserve rate policy, and then there's the U.S. trade deficit and the government debt, which is pretty much just a permanent debt. But yeah, whatever. So now let's go to the other side of the ocean, and let's go take a look at the euro. Now, the euro is a very tricky one. First, you need to understand, before we can look at the drivers, what is the euro? The euro is an accumulated currency to try and battle the US dollar. That was the original idea, which was nonsense, but it doesn't matter. We implemented it anyway. Everybody knew that was never going to work in the long run, but we did it anyway. The problem with the euro is that you take multiple countries with completely different cultures and different ways of behavior, consumer behavior, and you put them together. That's not going to work in the long run. However, we're stuck with it. So what are the drivers now? Well, number one will be the European Central Bank, what their policy is and key economics. So what's the key economics? Anybody have an idea? I want to see three countries. Who's the key economics in Europe? First one everybody's going to get. Yeah, like I said, everybody's going to get the first one. Germany, yeah, obviously. Yeah, France, number two. Yeah, that's it. Yeah, I bet you nailed it. You got all three. You got a bonus prize. Well, the UK was never really a driver for the euro because they were never part of the euro. When you talk about eurozone, yes, but that's on something else. That's not currency wise. No, it's not Swiss, but Italy. Italy was actually one of the drivers. Nowadays, it's going to be questionable what's going to happen, but Italy. Some people think the Dutch, which as much as me being a Dutchie would love to admit to, but no, we're not. We're just a small trading country. We don't really matter. Spain is never going to get it. But yeah, France and Germany are the stable two key ones, right? They're the biggest economies. Italy has a very large economy, but it's just too corrupt. But you know, they're still one of the drivers, right? So obviously the European Central Bank, the policy that they make is a lot of influence comes from whatever Germany and France and Italy are doing. Obviously, there's a lot of influence nowadays going on. You're going to see a lot of little key aspects playing into their central decisions. I mean, the problem is like I said, it's accumulation of different countries, right? When you had the German Deutsche Mark, the Deutsche Mark had your unemployment rate, same as the US dollar, right? You had your unemployment rate, the central bank of Germany, and you had the metal market because Germany has a massive wealth of natural resources, right? So that was their fundamental drivers, but those have fallen away because you now have like this accumulated, cluster. So that's why this changed. Now, oil and gas dependency is another big one. We're we're to this day still dependent on Russia and Spain, Russia and the Middle East. Sorry, I read Spain. I said Spain, but obviously Middle East, right? the higher the demand, these commodities tend to weigh the value of the euro. Yeah. So, I mean, Europe is a massive consumer. Not as big as the US, but yeah, we're very dependent on it, right? Um, so the other one is something called peripheral economies. Uh, The way I want to explain that one is exactly what I pointed out, right? It's the discrepancy between the economies in the different countries. I mean, you can make it really funny, you know, but that's the way it is. Like, I can make it very difficult now to explain it, but in essence, you will never get an Italian, a Spanish, and a Greek to think the same way a Dutch, a Belgian, and a German think on economic things. You will never get a French to agree with anybody except French, and even they don't agree with each other, right? And then you have, a few of the other countries that are stuck in between that are kind of just along for the ride. And the Dutch are kind of like, neutral. It's kind of like Switzerland, but not Switzerland. Yeah, they kind of just, follow people around. So, the economies are completely different in how they perceive to be and how to work with each other and what they want and how they see an economy working and what their underlying, policies are. So this is a huge factor. When you get them to align with each other, which doesn't happen often, but in some cases they do, you will see that the euro gains a massive amount of strength because there's a unified policy making made throughout the bloc. But in general, you get more disagreement than you get agreement. I think we all know that. So now we get to the other one, which is the UK, which is the pound. The pound, obviously after Brexit, has a little bit of, the drivers are not, they're still the same in essence. So obviously the UK economy, like London is still to this day, even after Brexit, at the moment, the center of the whole global fintech and the financial sector, the Financial Conduct Authority, FCA, all the regulations run through the UK still. A lot of it is still looked at London and see like, okay, what is the standard? I don't think that's going to change anytime soon because from a financial policy, it doesn't matter what the border is. So I think the GDP figures of the country, yeah, okay, the inflation and GDP figures of the country obviously have a direct impact on the GDP, but the other market in the UK that's extremely strong as part of the economy is the housing market, commodity and housing market. The UK is very unique. There's a lot of foreign investors in UK markets, maybe having one myself, but there's a lot of foreign investing, a lot of Asians, and a lot of people are buying real estate in the US, in the UK, and a lot of them have also something called like the Northern Powerhouse. If somebody's from the UK, they will know what that is. It's the Manchester area where they revamp a whole area for new building blocks. This is literally the main point is to get foreign investors to buy that stuff, to rent it out. That's the whole point of the Northern Powerhouse. It's revitalizing a dead area and get more investment, which also means that those people are liable for, taxes and stuff like that, which means more income for the government, right? So you're getting money from outside into the company, into the government, into the country from outside sources, meaning you're boosting your economy from outside inwards, and it's growing inwards at the same time. So that's one of the strengths of the UK. Obviously, Brexit was a very big driver for the last few years, obviously. What are the policies going to be? How we're going to move forward? What's going to happen? All right, so Brexit happened, and now we're kind of in limbo. A lot of the things that we were expecting to happen were obviously clear, such as, border issues, export of goods, import of goods. Everything came to a grinding freaking halt. Obviously, the infrastructure was no longer built for the old system. It's all built It was all built for the European the free trade agreement. Now that's gone, they have to reinvent half the old stuff. So that's going to be very much how the Brexit policies are going to develop, the post-Brexit policies, how they're going to develop is going to be a very big driving factor. All right, that's the major two for the UK, really. Obviously, you have the local bank, but I mentioned that is part of the UK economy, right? What the UK bank is going to determine. And then we have number 4, and that's the Japanese yen. Now, the funny thing about the yen is that people always say, like, but why is it not the Chinese? China is a bit funny when it comes to currency. It's actually not considered a major, which I know is funny in a sense, considering how influential they are. But the yen is still stronger. In a currency, it's considered a major. Um, the the reason behind that is very simple. The Japanese currency, so the yen, is the most traded currency in the Asian markets. So that's where that comes from. Like, it's not the Chinese money; it's the yen, right? So the Japanese yen, to be exact, right? So obviously, it's very adapted to industrial export. Everybody knows that, but the yen is like the US dollar in the sense that it's a little bit of a safe haven kind of status. The yen is considered as stable, as even though there's a lot of policy differences with the bank, but the Japanese currency it's very interesting in the sense that it's stable, yet it's also used by carry traders because of like an appetite for risk, right? Because it has like growth potential that it can have these huge bursts of growth. Yeah, exactly, exactly. And you can trust Japanese ethics. Yeah, they're very stable. They're very traditional. They don't really change much. They're not going to randomly start a new revolution tomorrow. Like it's not in their culture. So it's a very stable currency in that sense, right? Obviously, low interest rates. We know the Japanese bank has not been screwing. It was the first to go negative in the interest rates, but that was a fix. They also were always going to be very low in the interest rates. So it's very easy, obviously, for people to borrow the currency and invest it with higher rates. And obviously, their geolocation close to China is an influence, right? They have direct access to it. And then what we also see is one of the drivers, and that's more a downside, and that is coming back to the Bank of Japan, is they do tend to intervene a lot in the economy. They say they don't, but they do. Right? They continuous devaluation, they interfere. Uh, they seem to be very disapproving of the yen in general. Like they want to push the yen down. They think it's too expensive and it doesn't deserve to be that high. So we know this policy and they're openly saying it too, right? Usually it's like, no, the yen is too strong. We need to push it down. It's not really true because the yen is valued at what it's valued at by the world, but they're trying to push it down, right? And there is a downside, obviously, to a very strong currency because if you're export based and you become extremely expensive to export from, yeah, okay, because people that are importing, the price is going to be high, and then you're going to shift. However, with their industrial and the technical base, at the moment they're fine, right? But yeah, that's part of where they're at. I just noticed why is the yen in there twice. All right, well, forget about that. So we'll skip the yen. For some reason, I put it in twice by accident. The Swiss franc. So what about the Swiss franc? Well, the Swiss franc is very simple. Again, the Swiss, very stable, safe haven status. I mean, obviously, everybody knows that the Swiss franc has a very protected status, really. It's not as old the old days where they can just ignore everything. But yeah, the main drivers is that safe haven basis and obviously, healthy economy, gold reserves. And then the second one is obviously the national bank's policy. Now I'm just going to 2. Whoa. So that's where we're at. Now I just know why this one is here double, because this should be the cat. Nobody saw that. We're just going to go back into it. Oops. There we go. And the last one of the major currencies is the Canadian dollar. Now I'm going to touch on this very shortly again. Canada is very driven when it comes to US export, and it's very dependent on crude oil. That's the major drivers, really. We know that, right? If you put the Canadian dollar's exchange rate, so CAD dollar, and you put it against oil, it's almost like a copy of each other. Like they kind of move in sync, right? So that's a correlation. Now I want to briefly touch on commodities and stocks because we've got a lot more to cover. So commodities are a little bit different. There's the fundamental drivers with most commodities is straight up supply and demand. There are exceptions, yes, I know. And there's politics involved, yes, I know, like oil, right? But if you take oil, for example, most of it is, hey, there's 100 people asking for it and we can only supply 50, price goes up. There's 50 people asking for it and we can provide for 100, price goes down. It's really that simple. Now, what's the trick that we do on the other side, on the supply side, is obviously, well, when we feel like the price needs to go up because it's way too low, $20, we just stop producing for a while and choking production, meaning that supply goes low, demand stays equal or goes up depending on the time of year. There's some seasonal effect here. And we just force the price back up. But this is what they can do. This is what OPEC did last time, which also opened the door for Russia, but that's a completely different discussion. Now, stock, guys, for stock, it's easy. What is a fundamental driver for stock? Well, that's the underlying assets value of the yearly figures. What's the company doing? Right? If you want to know what the stock driver for Netflix is, freaking profit. That's it. What determines that profit? How many new subscribers are they getting every month? How many are continuous subscribers? How long do these people generally have a subscription? How many people are benching right now because of COVID? How many of you have benched entire seasons because quarantine? Like, yeah, that's why these stocks go up. So for stocks, it's very, very straightforward. Like commodities, supply and demand mainly. Stocks, what's the market? Not what is the market doing? What is the company doing? Right. So what is the market that the company is providing into? What is the geopolitical kind of aspect of that? So if you have tech, you have a little bit more difficult. If you have medical, you have a very big political game going on globally. Let's say COVID vaccines, right? So every company that is involved with COVID vaccines, their stock is going to fluctuate based on, let's say a Pfizer, their production versus the trade deals that they made versus how the vaccination deals are going, right? So that correlation is there. So if you understand those factors, you understand what the stock is going to do, right? So that's the drivers, roughly. Now let's go to a little bit more fun stuff, which is actually trading. Now, the trading is, firstly, you need to prepare before the announcement comes. So we're going to talk about trading the news. Right? Now, generally term, this is considered short term. Right? You're not going to trade the news for a month. You're going to trade the news for today, maybe a day or two. But generally speaking, it's like even less than that, usually like an hour or so. Now, first of all, you need to understand what is my strategy. If you don't have one, so then you can't apply it, right? If you already have one, then you just apply your strategy. But if you need to determine what your strategy is going to be, think of it this way. I am going to trade this, and this pair, which is, analyze the instruments or, identify the instruments, I guess. What am I going to trade during the news announcement? Let's say the NFP comes out. Which dollar related pairs will I be trading? Don't grab all of them. Pick 2 or 3. Okay. Don't pull all your eggs in one basket. That doesn't make any sense. Now, What you need to do next is, before the announcement hits, is analyze your instruments that you will be trading. So do your technical analysis. Check your indicators, check out, their status, where they're overbought, are they not? Then you're going to determine, okay, when should I act? And this is very simple. You basically have two choices, right? Before, during, or after. Or three choices. Jesus, I can't even count. Right? You can do it before, you can do it during, or you can do it after. And each one of them has a different mechanic to it. And that's why it's important to set your goal and accept the risk level you have predetermined to take. If you have proper risk management and everything else, then you have a fixed percentage risk. Now, during an announcement, because you're trading a shorter term trade, you want to have a little bit less of risk exposure and a little bit more adjusted goal. You're not looking for very long run type of trades for the next week or so, get 300-400 pips. You're looking at getting an announcement trade. So you either set it up before, so you go in if you're confident that it's going to be positive for whatever you're trading, right? So you take a buy, right? Or a long position, whatever you want to fancy calling it, right? So you take a buy position, you put your stop loss, and you take your take profit, and you stop touching it. Too many people want to play with it while it's moving. Like, I got a little bit more stop, a little bit less stop loss, a little bit more stop loss, a little bit more take profit, a little bit less take profit. Like, just if you do the math, if you do your analysis correctly, your stop loss and your take profit should be at accurate levels that you can just let it run. And if you got it wrong, you take a loss and you learn why you did it wrong and you move on. Taking a loss is not a bad thing. Losing is not bad. Losing is trading. It happens. It should happen, because if you're a trader that never loses, it means you're always married to your positions. It means you just refuse to close losing positions, which is a very, very bad habit. It's how you zero out accounts. Now, spread and commissions is one thing that I wanted to touch on really shortly. Spreads and commissions have a different ruling during news announcements. You will see that they spike. So spreads and commissions can spike. Now, commissions are usually kind of fixed, actually, but spread can have a really big difference on certain announcements. Like, the higher the volatility, the bigger the spread, the bid-ask change is going to change, right? So keep that in mind. Check with whatever broker you're with like FX, just check with them. During news announcements, what is the increase? I mean, it can be up to 300%, like 3 times. Right, so let's for example say, I'm saying example, it's not what it is. Let's say, for example, you have a spread of 1. During the announcement, it becomes a spread of 5. That means you need to cover 5 pips, right? So that's how you need to keep that in mind. Commissions usually stay the same because they're like a flat rate. Okay, so you did your preparations, you made all of these points. So how do you actually trade with this stuff? So short-term trading with volatility is basically trading the volatility. You try to trade the spike, whichever direction it is. Now, then I usually get, do I do a pending order or do I do this manually? Right, so here's my thing. Buy and sell stops are a terrible idea for short-term volatility trading. How many times are you going to have a buy stop or a sell stop that it nips it and then pulls straight back down after that, right into your stop loss? Otherwise, you have to make them so tight above the actual current market level with a stop loss so out of this range that doesn't make any sense. With a take profit that, like, at that point, it's like you're basically trading at market value. You might as well just go in before the market announces it, right? So when you trade manually, it gives you the opportunity to trade the volatility short term in 2 ways. During being the second that the announcement comes, if it is green, let's say, and you expect thus the market to go up, you just click on buy without thinking and then set up your stop loss take profit. Trust me, your trade's not going anywhere. You have a few seconds. All right. You're going to be trading for the next hour. You don't need to set the stop loss take profit in the next 0.3 seconds. It's going to move. It's okay. I see people getting stressed out way too much about this. They open a trade and the first thing, let me put stop loss. Okay, the market's not going anywhere. You accepted this trade and you expect this to run for an hour or 15 minutes. Like, you don't need to be the fastest person in the planet setting a stop loss. The market's not going to change that fast. Like, if it does, you just click close trade. Like, it's really not that hard. All right, so this is manual. The other option is that you wait for the spike to happen, whatever you see it doing, and then wait for it to stabilize out and then take the opposite direction, because you'd usually get the pullback and you trade the pullback instead. Now, keep in mind, this is all very short-term trading, and it's almost like scalping. Not really, but it's very short-term trading, and it's very small gains for a lot of work. Right? So in the long term, it's great for a little bonus from time to time, but you shouldn't make it your primary focus on how you trade. It's just little cherries on the top, like little nitpicks, little opportunities you can grab along the way. When we look at long-term trading for fundamentals, there's two different trades, right? You have existing trades and you have new trades. So when it comes to existing trades, there's a few micro managements that you do on a risk level. Let's say you have a buy on euro US dollar. You are currently 120 pips in profit, something stupid like that. What do you do before the trade hits? Is, first of all, you secure the profit with a positive stop loss. There's never a reason to lose a green trade because you get greedy. It's like, oh, even if it pulls back, it'll go back to the profit point. Yeah, but what if it doesn't? And in reality, you're more often going to hit a negative result at the end than, just take a little bit less than the max. It's okay, right? Profit is profit. I've never heard anybody complain about having more profit. I've heard them complain about losing money, though, and that's usually a very big topic for people to complain about. But not about more money. Now, if you find me somebody that does it the other way around, introduce me to them. I would love to pick their brain. Now, with the existing trade, that means you secure your trade. And with that, when it's secured, you let it run, and you can do a trail stop. You can do different things. This depends on what the trade is. But let's say we have 120. We expect a movement of about 30 pips on average in the immediate spike. Okay, so you go about 40 pips under your secure. So you set your stop loss at 80 pips. So guaranteed, no matter what the hell happens, those 80 pips are in your pocket. That money's yours. Now, if you happen to have the fundamental correctly, because you should have pre-factored already this in before you opened your long-term trade on Monday, you should have had the idea to look at the economic calendar for the week. Like, hey, okay, what's going to affect my euro trade throughout the week? What is the expectation? Are there already kind of like things known? If yes, good. You should have factored that in. Now, you have your trade, you have your secured 80 pips. What do you do next? You just bloody let it run. Put on a trail. The euro will have an average candle movement on 1 hour, an average one on 4, and an average on a day, and an average on a week. Now, we don't generally trade week, month, but we do trade day, 4 hours, and hours, and some of you trade lower than that, and that's fine. Take the average movement per candle, the average range, and just factor that into your trail, and just let the damn thing run. It should take profit, great. If it pulls back, great. And it should never, like what Abdul's just saying me, turn from green into red. If you lose green trades, it means you screwed up. And it's okay to screw up, but you have to learn from it. Right? Micromanagement of your trades means securing entry points and exit points. Right? So this is very strong when it comes to your long-term trades that need to be set up on a fundamental basis. You need to make sure that before that announcement hits, you secure your trades. If they are in red, it doesn't matter because your stop loss is a fixed ratio, it's a fixed place. In my other webinars, I explain how to do that. But let's say you have that set properly and it is 5%, you took that risk beforehand. So now it's either going to hit it or it's going to not. That was the same beforehand, so you don't need to change anything. The only time you change that stop loss is when it's in the green and you just secure a profit, or at least entry point, so you don't go red. New trades can also be done on a long-term vision, because you can have a trade like an interest rate decision, which is going to be a determining factor on where it's going. And if you take a buy and they do increase the interest rate, you can bet your ass on it that it's going to carry on for a week in an upward trend. So you just let the blood run. Like, yes, it's going to spike, and yes, it's going to pull back. But then the sentiment is going to be, well, they increased the policy rate. So the currency has gained a substantial stronger point from the local bank, which is one of the drivers with every currency. Thus, it's going to keep going. So there's going to be more sentiment to buy that currency, that underlying asset. That, ladies and gentlemen, is in essence how to trade, how to understand the drivers, how to trade the news. What we will do in the Q&A is going to a chart for you guys to show a little bit. But for those that are going to live with us, thank you for watching. I hope that this one was beneficial to you. Obviously, it's a lot of theoretical stuff. So, but thank you for watching and see you in the next one.